Good morning, dear children. Let's see about a new lesson in economics, that is gross domestic product and its growth. Well, it's otherwise called as GDP. We'll move on to the introduction. What is GDP or gross domestic product? It's a measure the amount of money brought into a nation in a single year through the selling of that nation's goods and services. Not only that, it's a measurement of how well a nation's economy is doing for a particular year. If a high GDP means the nation is doing well, if it is a low GDP, its nation is doing poorly. Well, what is this GDP? It's a market value of all final goods and services produced in a year in a given time of period. So we have four definitions over here. We'll see one below the other. The market value, it is goods and services are valued at their market prices. GDP rises if price rise. And final goods and services brought by final user. It's not like intermediate goods are produced by one firm, brought by another, and used as a component of final goods or service. It has to exclude sales purchase of intermediary goods to avoid double counting. For this double counting, we can have a good example from the book. Uh, when you're moving for a hotel to have a cup of tea, if a tea is cost of rupees 10, we have all the intermediary products. For an example, we have to have milk, tea powder, sugar to prepare tea. So, the intermediary products, the milk, tea powder, and the sugar cost separate. We cannot have the separate cost of all these things and preparing a tea, a final product, tea, as a cost. Whereas all these intermediary have been added at the final user. So this is what is double counting. If you are going to have all the intermediary products value as well as the final product value, it is called as a double counting. Well, we'll see to the GDP formula. Expenditure approach with C plus I plus G plus NX. So here is your income approach. All the total nation income, sales tax, depreciation and net foreign factor income. And the third one is value added approach. All the three denotes how to get GDP, how to calculate GDP, the method of approaching GDP. This is a formula to get national income. Well, we'll move on to the national income. What is national income? National income is the sum total of factor incomes earned by the normal residents of a country during the period of 1 year. It's also defined as a sum total of market value of final goods and services produced by normal residents of a country in 1 year. Well, this national income have been associated with the measuring of various terms. We'll see to that. We have six terms that has been associated in measuring national income. GDP, GNP, NNP, all these have been to be seen in detail. So, this GNP defined the value of all goods and services produced during a specific period of time. So, every definition says that calculating the value. What's the value? What that has been got from the country through the sales and service. So, all these have to be given for a certain period of time. This is what is GNP. And here is your formula for calculating GNP with the consumption, government expenditure, investment, and also export and imports. Export and imports are not added as it is. The export have to minus with the imports. Now, GDP again for your definition. That gross says that it includes all the three sectors, that is primary sector, tertiary sector, and primary, secondary, and tertiary. Well, domestic is only done in country. It doesn't exclude out of the nation. Production, the value of products and service in the currency which have been produced in single financial year, that is with 1 year. Net national product. This is also, well, net national product NNP is a final goods and services in a country during the year, that is GNP minus depreciation. Depreciation means the wear and tear. If you have a bicycle, if you have to repair that for a bill or with the pedals, that is not been added over here. So you have to list that depreciation. So that is what how you calculate net national product GNP minus depreciation. The next is net national product to the next domestic product. Domestic product is which all the product that has been products have been produced inside our nation. So when the depreciation is subtracted from GDP, we get the net domestic product. Per capita income, it's also known as a income of a person. So we can see in detail how it is calculated. It's also called as a indicator to show the living standard of the people in a country. So if real per capita income PCI increases, it is considered to be an improvement in all overall living standard of the people. So what is this PCI? National income divided by total population. So if the sum of all income received by an individual or household during a given period, that is called as personal income. We'll move on to the disposable income formula, that is personal income minus the taxes, what all the taxes that has been paid by an individual and the deductions that has to be reduced. So this is how we calculate the national income with all these 7 terms. The gross net product, gross domestic product, net national product, net domestic product, per capita income, personal income, as well as disposable income. Now we'll move on to the in detail about gross domestic product. How it has been measured? It has been measured with 3 types of methods. One is expenditure method, the other one is income method, the third one is production or value added approach. We'll move on to the calculation. First, let us see about the expenditure method. The GDP is measured by adding all the expenditure of final goods and services produced in a country during a specific period of time. A very simple calculation, what all the expense have been done by the nation. And the next one is income method. What all the income, the earnings of every citizen, that is called as a income approach method. The third one, the final one, we call it as production product method or a value added approach. So this comes under the final value of all goods and services, not with the intermediary goods. When the intermediary goods have been added, it is called as a double counting. So we have to reduce, minus, less that intermediary cost. So only the final value of goods and services have been comes under this value added approach or production method. Well, just have a look what all you have in this expenditure method, consumption, government spending, investment spending, all the stocks, imports have to be reduced and exports have to be added, the factor incomes, the value income, all these are the individual or the separate part of income that has been added and have been calculated for the method of finding gross domestic product. This is how we calculate. Well, we'll move on to the importance of GDP. Why do we want to learn about this GDP? To study about the nation's economic growth and problems of inflation and deflation, how the economy have been reduced and increased, and also comparison with the developed countries of the world. Not only that, the estimate the purchasing power, study of public property, public sector, and also guide to the economic planning, whether it has been reduced, it has to be increased, isn't it? So we have to plan for the future. Even if it has been increased, how much you can double the income, we can plan accordingly. This is what is the importance of GDP. Let's see about the limitation of GDP. We cannot be on increasing. So GDP does not take into account certain economic activities. What all those activities? So we have limitation in GDP. That is non-market activities. Especially it says about the services. So our mummy, mother will be cooking, isn't it? So her service will not be taken into an account throughout her life. If she serves, if he does the work, it is not have been considered as a national income. And also the services, the voluntary services, for an example, Mother Teresa service will not be taken into an account. So likewise, the negative externalities, the pollution, the monetary value is not taken. Not only that, the underground economy, there is much economic activity which, although income is generated, never reported to the government. Example, the black market transaction. You know well about the bribery that is not being taken into an account. So this is called as the underground economy, that is under the table. So many bribes have been given. So it's a curse for the nation. The black market and the money transaction that has been not accounted cannot be able to add it for the national income. Quality of life. GDP is often used as a quality of life measurement. There are factors not covered by it. So these include leisure time, pleasant surrounding, and personal safety. All these you can consider as a quality of life and not as a calculation for the national income. So several important goods and services have been left out of GDP. GDP measures only quantity and not the quality. So it does not tell us about the way income is distributed in the country, and the bribery, the underground, whatever, under table money, all these have been not accounted. The GDP does not tell us about the kind of life the people are. We'll move on to the sectors wise distribution in GDP. Primary sector, secondary sector, and tertiary sector. You know very well what is primary sector, isn't it? We'll move on. It is agricultural product, herding, and mining, all the red collar job is called as a primary sector. So this is how the composition of GDP have been given to the nation. From 1971 to 1980, 41% of agricultural sector have been produced, whereas the industry is 17% and service sector is 42%. But from 1981 to 1990, the agricultural sector have been reduced and the other two have been increased. We'll move on to the secondary sector. This is especially the conversion of products, isn't it? With the industries, energy, the mining, all have been converted into products. Tertiary sector, the sales, how the transport, the communication, everything play a vital role in the sales and improve the sales. So all these have been taken into an account. The three sectors of Indian economy says about agriculture, industry and service. This is what is the split and how it has been donating its offer to the economy for the national income. We'll move on to this pie chart once again. Agriculture with 18%, industry with 29%, and services with 53%. Over here also you have all these services sectors, everything. You can have a look. This is how the graph have been denoting the value also. So dear children, the economic sectors and the sector wise increment have been not done in a proper way, isn't it? So the development path of GDP and employment have to be given rise. We have a difference between the economic growth and the economic development. The concept of economic growth is narrower, but the concept of economic development is broader. So it compares with the quantitative and qualitative. So economic growth says about the development of nation, and economic development says about the developing economics, how to increase the financial value. So all these are the crises that to be calculated for national income. So for the growth of GDP and economic policy, sure that the agricultural product, industrial policy as well as the service have to be, new economic policy have to be developed. If in case only we can able to have the development of our nation, and also we can able to lead into the developing nations ladder. Yes, agriculture product, the production have to be increased by the green revolution, irrigation policy, food policy, the labor policy, everything. Industrial policy creates the economic development with employment, higher employment, research and development, modernizing with the technical products, with the economy self-sufficient. So all these gives a development. New economic policy says that in 1990s already you have learnt about this LPG. With the liberalization, privatization and globalization, the economic reforms had influenced the overall economic growth of the country as a significant manner. So with this we end today's lesson. Dear children, do your homework properly and complete the lesson. Thank you.